Welcome to Strictly Money at the News Forum, where all voices matter. I'm Saijal Patel. There's a popular saying when it comes to investing, and that is, quote, don't work for money, make it work for you. Let's face it, it's getting harder to build wealth for many Canadians. That's why investing, so your money makes money 24/7 while you sleep, is simply table stakes. And yet, investing is often ignored. Worse, it's often done without forethought or a strategy. If you're someone who's intimidated by investing or worried that you're not doing it right or that your investment portfolio may blow up, then I'm glad you're here. Diana Avigdor is an experienced trader and portfolio manager at Barometer Capital Management. She has a wealth of knowledge and insights about investing the right way, and she joins me now. Hi, Diana. It's great to have you on the show.
Hi, Saijal. Thank you very much for having me.
You know, I have this saying that anyone can slap a few stocks together and say they're an investor. You've been in this business for some time. If you did that, you probably wouldn't be in the business for very long. What are some of the biggest mistakes you see investors make?
Wow, Saijal, that's a great question. Let me start by saying that investing, stock markets, and money in general, it's where psychology meets finance. And don't underestimate the psychology part. The finance is learnable. The psychology is a little harder. So one of the things I see from early investors, you know, especially as media has become 24/7, you have access to information. Information has been democratized. It's on TV all the time. It's all over the papers. It's all over the social media that you're using. So one of the biggest issues are that I find people that are starting to invest, they want to hit that home run right away. And if they don't hit the home run, then it kind of clouds their judgment and breaks a little bit their confidence. So if investing is where, if money is a big part of your psychology, and if investing is where psychology meets finance, then I think that first and foremost, as you start out, you should make sure that your psychology stays intact so that you don't start making mistakes in the judgment. That home run comes with a lot of risk. So don't go for that home run. Start out by going slow and steady, and make sure that you put anything aside every certain period of time. That's the other mistake people make, is that they say, oh, this is not enough. It's not going to get me anywhere. You know, whatever it is, that little amount that you're able to put aside on a consistent basis, it's never too little. Put as much as you can, but just make sure that you put something, and make sure that it's consistent.
Yeah, I think one of the dangers that I see time and time again, and you know, I often teach investing to my clients, is that they make these bets, they get lucky, and they think that they're an expert. And yet we know that you can't really predict where markets are going.
Absolutely. You can't predict where markets are going. It's a tapestry. I like to say to new people coming into the business, I say it's like a puzzle with 100,000 pieces of the sea and the sky. And when you put together that first two pieces, it's very, very hard to put together, and you don't know whether it's the sea or the sky. The more you put together in the puzzle, the more you're sort of able to kind of say, okay, this is part of the sky, but I'm not sure where, or part of the sea, but I'm not sure where. So as you go along, things, bigger picture, things are going to become more and more evident. But it's just an assessment, and it's an opinion, and you should be ready to be flexible with your opinion. And, you know, spend more time identifying what's happening, not what you think should happen. So when you're investing, you know, if you're doing it on your own, other things come into play. If you give it to an asset manager, they'll do this for you. This is what we do, is identifying what's happening now. And if something doesn't go the way we think it should react, then we have to reassess our own views. And we're constantly cycling through our own views because, to your point, we don't know what will happen 5 years out. Lots of things can change. And news are flowing much faster now. So just make sure that you have a view, but if you're doing it on your own, you have to put a lot more thought into it than you think. You have to assess and reassess. But if you are starting out, you're giving it to an asset manager, you're putting it in a mutual fund or an ETF, there are different time horizons.
Welcome back. I'm here with Diana Avigdor of Barometer Capital Management. Diana, before the break, we were talking about risk management. It is an important piece. I mean, there's a saying that's, that successful investing is about managing risk, not avoiding it. When you're meeting with potential corporations and looking at investing, what are some of the things that you look for? What are the questions that you ask?
For when we meet with management, you first of all you want to know about the financials. You want to know about the inputs into the firm, both horizontally and vertically. In other words, what their supply, how the supply side works into the business, and then how the demand side of the business, so their customers, and what their projections are. There's different time horizons, both in terms of your investment time horizon, but also for companies, what they're hoping to achieve now, what they're hoping to achieve long term. And the way to long term is made up of short term strategies and short term things that they need to see happen in order to achieve that long term horizon. And then we always manage for risk, and this you have to do for your portfolio as well. If things are excellent, that's great. There's no questions to be asked. But you have to know what your worst case scenario is and what you're going to do if that happens. Since we can't predict the future, you need to know both sides of the equation. When we invest, and same thing when we talk to management, I mean, you're always going to hear a great story. Nobody goes out marketing to tell you a bad story.
That's right.
But you do have to ask those questions as to what keeps you up at night? What will happen if? What happens if the economy goes this way? What happens if this happens or that happens to your demand, or this happens with your competitor? What happens in the worst case scenario? And so for your portfolio as well, what happens if the market goes down 5%? What happens if this stock goes down 10%? What will you be doing in the worst case scenario? Because that's when you actually have to do something. Mm-hmm. You don't have to do anything when everything goes your way.
Yeah, it's an interesting point, because deciding when to sell a stock or a cryptocurrency, whatever it is, it seems like it's the more difficult decision. Certainly I hear about it because people think, well, what if it goes up and I miss out? Or what if I sell at a loss and it recovers? How do you manage those type of decisions? What sort of advice would you give to someone?
Okay, so this is where psychology comes in. You must manage your psychology. It doesn't matter if it goes up after you sold it and you made money. You can always get back in. What you missed is that period that you missed. It's not that you lost money. Making money, taking profits, and the stock going up is not the equivalent of losing. It's just not making more. So it's a different side of the psychology. You do also have to have, in my opinion, 3 time horizons. The very long term, medium term, and the short term. When you start out investing, when you start out saving, first you have to save a little bit. That we've talked about this a little bit at a time. Make sure that you have a consistent strategy. In the very beginning of your investment, that goes into a very long-term horizon. You don't take your first year saving, let's say, or your first 10% to your target and put it in that home run small cap stock that you think is going to go up 100-fold in 10 years. That's not the strategy. The strategy is short, slow and steady. You start taking your savings and you put it into something safe and regular every month or every whatever period, and it's a long-term investment. As you get to about a third of your target money, or what you think you want to have at the end, or what you can have at the end, then you can start subbing your portfolio into some subgroups. Taking positions that are shorter term and can go up the risk curve a little bit. And only when you've reached maybe the last half of your, you've now accumulated half of what you think you can, and you've now reached a certain amount of money that you feel comfortable. Now you can start playing with risk, and that's a shorter time period. So there are three sub portfolios in our savings, in my opinion. You have your core,
Yeah.
which is not the home run 100 times profit in 10 years. It's your core. It's your index fund, or it's your core stocks. And then you have your medium term where, it's something that you watch more often. It's something that you're looking for a catalyst, maybe a few months.
I'm going to pause you there, and we're going to talk about portfolio structure when we come back. Welcome back to Strictly Money. I'm here with Diana Avigdor. Diana, before the break, we were talking about portfolio construction. I want to get your thoughts on the 60-40 strategy. This is basically, a traditional portfolio where you're 60% in stocks and about 40% in bonds. And the objective really is long-term capital appreciation and capital preservation. I'm hearing a lot more these days that that sort of structure doesn't hold anymore. What are your thoughts?
Yeah. So I'm of the view that we've seen generational lows in rates. It has taken us a few decades to get there. And we're coming out of major bull market in bonds. And so you're buying very, very high. Mm-hmm. So that I hear you on the 60-40. But somebody young, for example, and I mean, let's say less than 40, 50, or life expectancy has gotten longer, there is no need for them to have a little less than half of their portfolios in bonds and buying them at an all-time highs. So 60-40 portfolio mix, in my opinion, for somebody who's still working, still saving, it's not the right mix. You should have more in equities. There are different sectors and groups within equities that are more conservative and less conservative. And maybe you want to think about that in terms of capital preservation and capital growth. I mean, if you buy a bond fund, for example, mm-hmm. You can lose on bond funds. It's not, I mean, if you buy a bond, and hold it to maturity,
you're not going to lose.
You will be able to get your money back. Yeah. If it's, but at a very low rate, but if you buy a bond fund, you can still lose on a bond fund. So within equities, there is high risk stocks, medium risk stocks, and then there's the blue chips. And when you think about your risk tolerance in the portfolio and how you want to tilt it, maybe you want to tilt it more towards blue chip stocks and less of the more volatile stocks, and thereby take care of that 40% that you may be going to take down to something less. Rates are moving upward, and bonds will get hurt as rates move upwards. We've seen at the high, I think, $17 trillion in negative yielding bonds. We're now at about 14 globally. Two central banks have raised rates just last week, and the Fed is getting ready to start tapering an incredibly accommodative policy. So yields are moving up. I think you're worried about inflation. Equities are a hedge for inflation. Bonds are not. So I would tilt it a little bit heavier towards equities at this point.
Diana, we have about 2 minutes before our next break. One of the key, I guess, what's really important about portfolio construction is diversification, right? You want to hold things that are not highly correlated. And yet it feels, at least to me, over the last, say, 7-8 years, that it's hard to find that things are, because of globalization, that things are a lot more correlated. Are you finding that?
The thing that, in my opinion, has gone on over the last little while is that markets move very, very fast now. And rotations happen underneath the index very fast. So, growth, technology stocks versus commodity stocks, they work in opposite directions, and then they switch really, really fast. So you have to be careful with diversification, that you don't diversify yourself to zero return. And when there is a problem, all correlations go to one and everything goes either up or down. As we've seen in March 2000 when COVID hit, it didn't matter where you were. If you're going to do it yourself and invest in your own stocks, you really do need to spend some time. I think back to the beginning of our interview, what people do wrong. If you're going to do it yourself and buy stocks yourself, you got to spend some time on this.
Yeah,
you got
do
to
your homework for sure.
Watching it,
and
you
like
might
you
as
said,
well give it to a manager. Yeah,
and like you said, you can actually over diversify. Welcome back. Our guest this show is Diana Avigdor, portfolio manager and head of trading at Barometer Capital Management. Diana, I want to get your thoughts on active versus passive investing. We know that passive investing is very popular. In fact, I think the ETF industry is pretty much matching in terms of assets now the mutual fund industry.
Yeah, absolutely. So when you start out on your investment path, we spoke about your core. I think the core has to be passive. As you grow your portfolio. Why I say that is I started out by saying that money is where psychology meets finance. You don't want to take your first bunch of savings and put it in that stock that's going to take you to zero or blow up on you. Let's say it's a small cap and not work for you. You don't want to shatter your confidence. You want to build a nest egg, and you start out with passive. And passive has its pluses and minuses. It's cheap, but it can throw you around in terms of volatility a little bit. But not if you invest in an index. As you grow your portfolio and you go into the subgroup of midterm and small midterm and short term, you can move up. You start becoming more active. I would warn people that if you're going to be active, be ready to spend some time on your portfolio or give it to a portfolio manager to do that for you, because it's not a short term. You can't just leave it and not watch. But I would start out with passive and move on to active. In active management, you have to spend time identifying what works, not what you think will work in the future. Market goes against you. You need to figure out why are you wrong. So you have to spend some time. So passive into active. And then as we move through our age and the cycle of our investment, we go back to a more less risk as we take off the risk, because active is more risk than passive sometimes. So this is how we move through our age cycle. We take a large chunk of our age and savings and we go active so we can change things, but subgroups, not your whole portfolio, should always be your core holdings.
Diana, what's the biggest risk event that you're watching right now? Is it the debt ceiling? Is it inflation?
The market has been powering ahead despite of rolling negative headlines and some of the stuff that you mentioned. Equities are a hedge for inflation up until inflation is probably around 5-6%. Then it starts maybe becoming an issue. But even then, you can find companies that benefit from inflation. I think the biggest risk to watch right now is policy mistake. The market is used to accommodative policy and help from the central banks and the governments. And central banks and governments have to be very careful as to how they're taking out this accommodation so as not to shatter existing situations. In other words, if policy mistake would be raising rates too fast or tapering too fast before the market is able to absorb it. So I don't think there is inflation yet. I think the debt ceiling will be fixed. We've had the headlines out of China but the property
For the
manager.
Evergrande, yeah.
So people are worried about whether that's a contagion, but that doesn't seems to be working through. So I always watch that there won't be a policy mistake, because that can have some implications.
Yeah,
I think,
because the market really does hang on policy, the words especially that come out of the central bank, don't they?
yeah. So everybody hangs on their words and FOMC minutes and what our central bankers are saying, because the market is flush with liquidity, and as you take out liquidity, it's the de facto tightening, and so a policy mistake. Market needs a Goldilocks situation right now, not too hot, not too cold.
Yeah.
Has to manage that. It's not hard. It's not easy, but they're doing it so far.
Diana, it was great to have you on the show. Thank you so much for your insights.
Thank you very much.
Diana Avigdor. Well, a lot of great insights from Diana Avigdor. As I said at the beginning of the program, investing is one of the most important levers to building wealth. And it's because of the compounding effect, where earnings are reinvested to generate even more earnings. You think nothing is happening, but the magic, the benefit, happens 10, 20 years later. Investing doesn't have to be complicated either. By following some basic guidelines, tips that you heard today, including being diversified, having discipline, and knowing that you can't time the market, so having a risk management strategy in place is key, so you can be set up for success. Well, if you have thoughts or questions about today's show, send through an email, because I'd love to hear from you. Until then, stay well, stay wise, and stay wealthy. Thanks for watching.